Hello, everybody. Ed Yardeni here. It's December 29th. And I hope you all had a great holiday season so far. Christmas, Hanukkah. I got lots of presents. I got some nice things. I got a tie with the Yardeni Research logo on it. I'm not quite sure where I'm going to be wearing it. Also got a tie with Max's face on it, splattered all over the tie. So again, I'm not quite sure where I'll be wearing that, other than maybe inside the house for family gatherings. But anyways, I'm happy with my presents. Hope you're happy with yours. We got New Year's ahead of us, and then we've got the new year ahead of us, 2026. Obviously, a lot of known unknowns about 2026, and maybe more known unknown unknowns that we need to worry about. But right now, let's focus on what we know. What we know is that the economy continues to be quite resilient. It's performed exceptionally well this year in the face of some real stress tests, like the tariffs. Clearly that was an issue. And of course, we also have kind of been stress testing the AI trade. We started out the year at a record high. I think that was on in February, but we took a dive there, and after DeepSeek was introduced back in January of 29, we took a significant drop in the AI-related stocks. But then the AI hyperscalers during their Q1 and Q2 earnings seasons reported that all steam, full steam ahead. They were going to go ahead and continue to spend billions of dollars on data centers, and they claimed that they needed that because they needed to increase capacity because the demand was there. And so that brought that trade back up. The market made a bottom in April when President Trump backed off. I think it was April 9th. He backed off on his the tariffs that he was talking about, the reciprocal tariffs. And the market concluded that tariffs weren't going to turn out to be a very big deal, and that the president would probably back off on some of these things. And then along the way, there was a possibility that the Supreme Court might rule that it's all unconstitutional anyways. And I guess we'll find out in January what the Supreme Court rules, but there's a good chance that the Supreme Court will rule that the tariffs are unconstitutional. Only question is how much slack they'll give the administration in terms of the ability to have some time to come up with alternative tariffs to deal with it. The administration claims they're ready to do that if necessary, but that could be a bit of a shocker in January. Generally speaking, the consensus of investment strategists, Wall Street's investment strategists, is bullish. Of the ones that are collected by Bloomberg, nobody's got a number lower than 7,000. So everybody's expecting the market to be up going into the new year. One of the top numbers is 8,100. We're at 7,700. I'll show you the chart of that in a minute. But I'm thinking from a contrarian perspective, maybe the first half is going to be choppy, kind of like what happened this year. This year we all started out pretty optimistic, and then we got hit by the tariffs. I guess we should all have anticipated that Trump was going to push it. He obviously was very gung-ho on tariffs, but I guess nobody really anticipated, or very few people anticipated, the extent that that would rile up the markets. But again, I think it wasn't just the tariffs. I think it was also the DeepSeek announcement that they had come up with a large language model that they had trained more efficiently, more cheaply, with less powerful chips than were being used by the other LLM trainers. Looking into the first half of next year, I think the year is going to be pretty good. I mean, we've got a lot of stimulus, fiscal and monetary stimulus going into the new year. That's the good news and the bad news. If Friedman's right, the monetary policy acts with a long and variable lag. By the way, we did question that view when the Fed tightened. We argued that the only thing long and variable about monetary policy is the uncertainty of when tight monetary policy will cause a financial crisis, which leads to a credit crunch, which almost immediately leads to a recession. So there really is no long and variable lag in monetary policy when it's tightening. Once it tightens to the point of creating a financial crisis, and maybe that's the uncertainty of how long it'll take before that happens. But the yield curve often anticipates that something will happen. The yield curve did that again when we did see a financial crisis in 2023 that lasted about a weekend, and then it was off to the races again. This time around, maybe it'll work. Maybe it'll still work. Maybe the easing of monetary policy since last year. Last year, the Fed lowered the Fed funds rate by 100 basis points. We warned that that wasn't really necessary, that the economy was resilient, and that the bond market might not take too well to it. And as we've discussed before, the bond yield went up 100 basis points. So that didn't really help that hurt the mortgage market, hurt the housing market. So did the Fed really ease starting last year? But they kept going. They kept going. They just wouldn't listen to me. They went by 75 basis points this year, so 175 basis points all told is the drop in the Fed funds rate. And yet the bond yield remains around just north of 4%, and the mortgage rate remains high. There hasn't been much evidence that the Fed's easing has eased credit conditions in the mortgage market. Here we are. Maybe we'll get some stimulus out of all of this going into the new year. Certainly, there's a new QE program. There's some controversy whether it really is QE, but it's QE. I mean, the Fed's going to be buying $40 billion of Treasury bills at least through April. They claim it has to do with maintaining stability in the repo market, but that's what they're doing, and it is a stimulative policy. But the really stimulative policy is the big beautiful bill, the act that was passed last year in July, and it was retroactive to the beginning of last year, but it wasn't. The real impact of that will be this year when a lot of people get a lot of refunds, as Secretary Bessent has said. It could be $1,000 to $2,000 in rebates, and a lot of people are going to notice that it's more than they got last year, and so that could provide some significant fiscal stimulus in the first half of the year. So all the more reason to think that the economy is going to continue to grow. If the labor market continues to be funky with not much growth in payroll employment, it would all have to be productivity. So we could have another year of kind of second year in a row where productivity clearly is better than 2% per quarter. And that would be the good news. The bad news is that the bond vigilantes might really not be focusing on the productivity side as much as they will be on the deficit side. I presume if there are all these rebates, the refunds that are owed to taxpayers, the Treasury is going to have to raise some more money in the first half of the year. And so we could very well see a significant widening of the federal deficit. Combine that with the perception that the inflation rate hasn't yet gotten down to 2%, and yet the Fed has already been quite stimulative, easy as far as monetary policy is concerned in terms of lowering the Fed funds rate. Again, I'm not quite sure it's been all that stimulative given the reaction of the bond market, but the bond vigilantes may just see a combination of irresponsible, excessive fiscal and monetary stimulus and conclude that maybe the bond yield at 4.2% is too low, and it needs to go lower. And it could go higher, and it could go higher quickly, as we saw before. I mean, 2023, it went up by from 4 to 5% in a heartbeat. So I think that's the risk. That's the potential for unexpected volatility, at least in the marketplace. Speaking of unexpected volatility, silver breached $80 over the weekend or overnight, anyways, and then it took a big dive to the downside. I guess profit taking. It is a little bit uncomfortably reminiscent of I think it was the 1980 bunker hunt silver crisis, where the hunts tried to corner the silver market. They kind of blew up in their face, and the silver took a dive, and that was also the end of the gold rally for a while. Maybe that's what we got going on right now, but actually, this may turn out to be pretty healthy for the precious metals. It wasn't healthy to see them kind of go straight up. So having a uh, a sell-off here, which is what we have today, maybe even a bit of a plunge, is a good development in terms of the long-term bull market for gold, anyways. Not really that opinionated on silver, but clearly, if gold does well, the precious metals should do well. So I haven't had second thoughts yet about my targets for gold next year, but that'll be something to watch, of course. Why don't we have a look at a couple of charts? The really good news here is that we've got the that the earnings story remains very much intact, and it's really been earnings that have fueled this bull market in stocks. The forward PE has been at 21, 22. It's been volatile around that level for a while. I mean, it actually got there, I think 6 months after the end of the lockdowns in 2020. We zoomed up to a multiple of 22. Then at the beginning of this year, we were also around 21, 22, and then we had the sell-off on the Liberation Day tariffs, and now we're back at 22. So there's been a lot of volatility, but the S&P 500 since that point in 2020, where we got back up to 22. Since that point, market's up about 100%, S&P 500, and forward earnings are up 100%. So it's really been, I would say, an earnings-led melt-up in many ways, which obviously is a healthy one. It's a sustainable one. That doesn't mean that 22 is a sustainable PE, but I think it might be sustainable as long as the market agrees with me that we're not going to have a recession over the remainder of the roaring 2020s. Well, let's go have a look here. Yeah, I apologize. Max was here, then Max decided not to be here. Again, when my wife is in her office here, he tends to go over there. She's maybe got a more comfortable couch. But as you can see, he left his party hat here. I was trying to put this New Year's party hat on him, but maybe that's the reason he didn't want to stay. He didn't like it. But that's a sign of Max. That's maybe what Max will be wearing in the new year. Okay, so let's get serious here and look at a couple of charts. This is from Quick Takes. I have been putting out Quick Takes. Everybody else at Yardeni Research is taking some well-deserved time off. This has turned out to be a bit of a hobby for me, so we didn't go away for the holidays. We are going to go to St. Martin, I think, if I'm right, in February. So we like to travel when things aren't as wild as they are right now, and the weather's kind of crazy. Though, by the way, I am going to be in the Midwest in Des Moines, Chicago, and St. Louis in January. So wish me luck with the weather, anyways. Well, speaking of luck, we've been very lucky to have this great scenario in the stock market with an earnings-led bull market. You can see this is back here in 2020. This is the beginning of the roaring 2020s. We had a big decline in the forward earnings of the S&P 500. This is the S&P 500 forward earnings This is what it looks like, excluding the Magnificent Seven. They're kind of similar, and it's definitely true that there's been a growing gap here, indicating that the forward earnings of the Magnificent Seven have been much stronger than the impressive 493. But this is the impressive 493, and they've done reasonably well, maybe lagged behind the overall number. But I think I don't know about you, but I'm starting to get AI fatigue. I think there's so many things happening in the AI world. There seems to be a lot of competition. There seems to be a lot of innovation. Looks like the Chinese have come up with some optical version, optical chip that uses light rather than electrons to create chips that can be used for artificial intelligence. There's some questions of whether it's a complete triumph over the latest NVIDIA GPU chip or whether it's just very specialized for video. But clearly, the pace of change is mind-boggling, and I think the fatigue may result in people no longer willing to assign as high a forward PE to the Magnificent Seven because of all the uncertainty of who the ultimate winner is. But at any rate, so we had this lockdown scenario, and then forward earnings zoomed right back up. Then we had, during 2022, we had Russia invade Ukraine, and that created anxiety about inflation, about the Fed tightening of monetary policy. So forward earnings declined. And then by the end of, well, by early 2023, companies and industry analysts started to get more confidence that the tightening of monetary policy wasn't going to cause a recession. That was our shtick for this whole period. When so many people were talking about a recession, we said it's not going to happen. And so the analysts started to catch up with our view, and forward earnings really took off here for the S&P 500. They had a little bit of a Liberation Day a weakness here, and then they've taken off again. And it's not all the Magnificent Seven. This is, again, the impressive 493 have done relatively well as also. Now, clearly, if this just continues to go at this slope and this goes at that slope, you do want to own the Magnificent Seven and overweight them and all that. But my hunch is that the competition is going to start to slow down the rapid increase in forward earnings, or the spread between the forward earnings of the S&P 500 and the impressive seven, and the magnificent. I'm getting all confused. The impressive 493, and this being the magnificent seven. So maybe that slope just doesn't, that differential doesn't widen, and people kind of give more attention to the impressive 493. Well, this is, I don't think I'll get as confused on this chart between the 493 and the 7 and impressive and magnificent. So this is something we try to update you on a weekly basis, try to show it to you whether it supports our story or not. But it's an important part of our story that we always tell. It's the data we look at, it's forward earnings. What are analysts saying that earnings are going to do this year, next year, and so on. So this is what happened in 2025. You can see that the expectations actually held up pretty well. They did get kind of knocked down a bit during Liberation Day, but they've recovered. All in all, not a lot of volatility. Then over here, this is 2026. You can see that we've had a dip here again at the beginning of the year, and now we're back up. And 2027 is very, very optimistic. Now, who cares about 2027? Well, the market cares about 2027 because the market, we think, is PE times Z, is forward earnings times the forward valuation multiple. So the forward valuation multiple times forward earnings. I'm talking too fast. So here we've got forward earnings converging with 2026, And now they're going to converge with 2027, wherever that might go. Might go higher, might go lower, might go steady. I mean, we're using, we agree with the analysts that it's going to be 310 next year. And analysts are getting ahead of our number. We're using 350 next year. So they're more optimistic than we are. But both of us are clearly optimistic. And so forward earnings are right now. You can see over here they've gone above where we thought they would go by end of the year, that $313 dollars per share. So again, the earnings, the analyst expectations is really quite heady, and we keep it pretty simple. The analysts we think determine what consensus earnings are, what those expectations are that go into the market. And it's up to the investors to figure out whether they agree with those numbers, whether they think they're too optimistic, too pessimistic, or just about right. And it's up to the investors to come up with a valuation multiple. And right now, the investors seem to be remarkably comfortable with 22 as a forward PE. They're really quite comfortable. The analysts are obviously quite comfortable with a number of for 2026 of 313, which just happens to be the same as the forward. And here we are at 6,900 based on PE times Z. We also in this particular quick takes, we looked at some of the contrary indicators and to see where they are. And the consumer confidence survey, as depressed as it is showing that people are actually pretty optimistic about the outlook for stock prices. 52% of the respondents to the consumer confidence survey, that's this dotted line, I think that stocks are going to be higher a year from now. This is the 12-month average, which is again quite elevated, especially when you look at the history of this thing. So from a contrarian standpoint, there's too much bullishness, and that might be bearish. On the other hand, if we're right and there's not going to be a recession over the rest of the decade, I mean, there wasn't so far in the roaring 2020s. Maybe this resilience continues. That has implications for the multiple. The multiple typically is very sensitive to expectations of a recession and whether it happens or not. So when there's expectations of a recession that doesn't happen, you typically get a correction. When there's expectations of a recession that does happen, you get a bear market. And so there is some correlation. It's not perfect between this number from above that is the 12-month average of people's expectations that stock prices will be higher, which could only happen if they don't think there's going to be a recession. And the forward PE of the S&P 500. Remember, I told you it's been here before, and this is on a monthly basis. We're back to where we were in terms of the highs for the PE, and it may be sustainable for quite some time as long as we don't get a recession scare or an actual recession. The press was full of stories about how ETFs have attracted a record 1.4 trillion so far this year. It'll probably get to be 1.5 trillion this year. That certainly sounds like a contrary indicators. Too many people rushing into the market, but you have to offset that by money coming out of the mutual funds, and so this isn't particularly alarming. This used to be alarming when foreigners kind of came plowing into our markets. That would be a concern. And we're seeing that for all the talk about the dollar weakness because foreigners are bailing out of the stock market and the bond market, the Treasury's data just belies that completely and totally. The latest 12 months equity inflows by foreigners, net equity inflows, was a record 714 billion dollars. That's the 12-month. That's this one here. And then on a 3-month annualized, it was almost $1 trillion. So they're still buying our equities. And in the past, when they kind of had peak buying, you didn't really know that until it stopped. And so maybe that's the story here. Maybe we won't know it until it stops. But right now, I would say it's real money. The bull bear ratios, the investors' intelligence is On the bullish side, in terms of bull bear, in terms of relative to its average, the AAII is slightly below its average. Nothing screaming at us here that you want to kind of necessarily bail out or bail in. I mentioned before, this is the another quick take. So we did looking at the S&P 500 projections of the Wall Street community. Let me just turn that off. Thought I had. Um, and here's the average expectations for the market. The market is currently around 6,900, and the lowest is 7,000. The highest is 8,100, where it's 7,700. Usually, we tend to be contrarians and tend to be contrarians on the optimistic side. Uh, we're 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 optimistic. We're siding with the strategists, but we are adding some nuance here that it's not going to be straight up. We think we are going to have some volatility and some downside maybe in the first few months of the year. This is the earnings expectations, and again, we're here somewhere in the thick of this thing at 310. There's a lot of 310s, so that seems to be uh, well, the average is 306, but the expectations are positive, solidly positive for earnings. Meanwhile, the weekly indicators on retail sales look pretty good for all the talk about the consumers caving in. They're not. We still think a lot of that is the baby boomers retiring and spending their retirement assets. We think that the savings rate's going to go negative between now and the end of the decade. People will probably freak out about that, but it'll have a lot to do with the baby boomers retiring and spending their net worth. Disposable income was disappointing, but it could continue to disappoint because a lot of baby boomers who are at the top of their wage and salary profiles are going to be retiring, and meanwhile, I mean that's going to depress disposable income. But like I said, they're going to be spending. The labor market continues to be confusing, funky, hard to assess. It certainly looks like there are a lot of structural factors that are weighing on supply and demand. Not clear that the Fed's easing is going to help much, especially if some of this has to do with AI related issues. Um, and I mentioned that one of our accounts made a good point, and that is uh, maybe a lot of companies are going to find that AI isn't all that useful for what they need to do. But meanwhile, the fact that they're kind of looking up and down throughout their organizations for where AI could be used might cause them to find a lot of areas that can be uh, eliminated, that can be improved in terms of efficiency and productivity without necessarily using AI. Um, Oh, that's the gold chart. We were thinking it was going to kind of go sideways for a while. Instead, it made a new record high. Maybe sideways is still the right call. If that's the case, sideways to the middle of the year would be a healthy development, and then a move up to our new target of 6,000 versus 5,000. Maybe should I kept it at 5,000 and waited a little while to get more closer to it. But that's what I'm out with at this point. So far, I got one question from Lee, and I've had a nice. It's a remarkable turnout we have here. So I guess some of you are doing this from the beach, and I hope you're having a good time. It would appear that the lower the consensus of earnings are, and the more they are wrong, the better the market performs. Is that consistent historically? Yeah, I think that's a reasonable. I mean, it's psychology, right? I mean, we do look at NARI, net earnings revisions by the analysts, and you're raising a good point. Our analysts getting too optimistic about next about 2027 and maybe even 2026. Their numbers for 2027 are higher than mine, but I got no problems with their 2026. And of course, in a roaring 2020 scenario, we may continue to have better than expected earnings. I think we had that this year. A lot of analysts lowered their numbers, and we've shown you the quarterly expectations. They lowered their numbers substantially for the first quarter, because of the tariff talk, and even more so in the second quarter because of Liberation Day. And then they said, we're not going to get fooled again. And they didn't cut their expectations as much for the third quarter, which turned out to be absolutely gangbusters. So they didn't cut their estimates as they had before the first two quarters, but the earnings were phenomenally strong. And now let's see how the fourth quarter plays out. There happened to be a government shutdown, and that might have had some impact on earnings. Okay, Jonathan. Hi, Dr. Ed. Can you briefly explain why you expect some volatility in the early months of 2026? I joined a little late. Thank you. Yeah, you did join a little late, and I did cover it, but I'll be happy to mention it again or summarize it again. And that is, it may be too much of a good thing in the first half of the year. The good thing is monetary policy has been stimulative. Really, it started easing in 2024, continued to do so in 2025, and a lot of that stimulus may finally show up in 2026. Meanwhile, at the same time, we have a situation where the Fed since December has had announced that they're going to do $40 billion a month in what effectively is quantitative easing. So monetary policy, at least from the Fed funds rate and QE perspective, is easing. Whether that's had an economy, a credit market-wide impact is questionable, as I mentioned before, because the bond yield hasn't cooperated. But the bond yield at 4% is something we could certainly live with. But when you combine what the Fed's easing, which the bond vigilantes may view as excessive, with what clearly could be viewed as excessively as a widening of the federal deficit in the first 4 to 6 months of the year, because tax refunds have been bloated by the big beautiful bill. Combine those two, and the bond yield may jump up, and it's 2023 jumped up by 100 basis points. I think the year after that it jumped up by about 75 basis points. So we could have a pretty quick negative reaction by the bond market, especially if we get some inflation numbers that still show that we're not that we're closer to 3% than 2% on the inflation front. All that would add up to strong real GDP growth, which then I think would be more good productivity growth, which should keep inflation low. But the bond market on a short-term basis may not quite see it that way, and we could have a pickup in the bond yield, which would unnerve the stock market. So that's one possibility of what could kind of rattle the market. Let's see, we got a couple more here. William, is the degree of disparity in forward earnings predictions usual? Ned Davis versus Goldman? Yeah, I think so. I think the important thing in terms of the strategists is that nobody's bearish. I mean, there's a couple that are basically neutral, thinking the market's going to stay here. But fundamentally, everybody's bullish. Same thing can be said on earnings. So maybe from a contrarian perspective, that's something to worry about. But I guess I'm not allowed to be a contrarian when it comes to being bullish here, because I've been promoting the Roaring 2020s thesis, and so far so good. So I'm not going to, suddenly pull the plug on that. I'm going to acknowledge that there are risks to the Roaring 2020s continuing to work between now and the end of 2029. But right now, as I said, so far so good. Lou, Ed, is there any risk of deflation due to low crude oil prices, lower owners' equivalent rent, and lackluster global economic demand? It's a good question. With regards to lackluster global economic demand, I have to say I'm pretty impressed by how well the global economy has held up in the face of Trump's tariff war. And I don't think we've really seen deglobalization. We've seen sort of the rebalancing of globalization, where China's trying to do more business with the rest of the world and not be as dependent on the United States. The United States is trying to do more business with Mexico and Vietnam and other countries other than China. Meanwhile, global economy seems to be holding up remarkably well, and we're maybe seeing that in commodity prices. I think some of the commodity price thing may be a bit of a kind of a speculative melt up that maybe is going through a bit of a correction here or a short-term meltdown. But overall, the global economy looks okay. But with regards to deflation, there is a lot of oil out there, that's for sure. The U.S. is exporting 3 to 4 million barrels per day in oil. So we are an exporter of oil. We're an exporter of natural gas. Uh, China has moved to electric vehicles, so they're using electricity more, and they're not shy about building more coal generating plants and running things that way. So oil, the only thing oil has going for it is everybody seems to be very bearish on it. And we've seen the U.S. Blockade at least some oil ships, not anything run by Chevron, but everything else they seem to be trying to capture oil ships from Venezuela, and that really just stabilized the price shortly. It hasn't really caused a big increase to the upside. Brent is trading around $60 a barrel, and that's kind of a crucial level. You fall significantly below it, and you'll fall significantly below it. But yeah, I'm not really that worried about inflation next year, quite honestly. And again, that's consistent with our roaring 2020 story. And if 2025 was the clear-cut example of productivity growing better than 2%, and it continues in 2026, unit labor cost inflation is going to be like 2%, and that's going to keep inflation down. But again, that's not to say that the bond market's going to listen to me and won't get upset about a widening federal deficit. And then finally, Hans, do you have a long-term view on UST bonds, mainly the long end as expressed in the price of TLT? I'm kind of neutral there. I mean, in a range. I've been using 4 to 5% as a range for a while, and kind of narrowed that down to 4.25 to 4.75%, and we're still below the bottom of that range. But I think we could be trading at 4.25 to 4.75 in the coming year. And then ask me again. Well, look, everybody, have a happy New Year. Sorry to disappoint you. Max disappointed you, didn't show up, but I think we'll take off next week. Let everybody sleep late. And again, really appreciate all your interest in our research for this past year and for many years for many of you. Let's wish each other good health and happiness and prosperity in 2026. So let the good times roar. Thank you.